All right, we are in chapter 11, and we're looking at 11, 12, 13 all together, but we're starting with chapter 11, just objective 11.4. So we skipped a bunch because we were really focused on the component of chapter 11 that has to do with financial analysis, which is what we're ending the semester with. So here we have earnings per share, which is a GAAP metric that specifically is focused on earnings per common share. So you're going to start with net income, and this is net income. And if you think about it, net income is net income to common stock holders. So we take out the effective interest expense to get to net income. And that's because the financial system is really from the perspective of the owners, the financial accounting system. You're going to subtract out preferred dividends. Now, we didn't really talk too much about this and how to calculate it. So if there is preferred stock and preferred dividends, you'll be given this number. And then finally, there's this thing called weighted average common shares. We didn't talk about calculating it, so you'll be given that number as well. But it's just a measure of, let's say you started with 1 million shares on July 1, and on January 1, and on July 1 you issued another million, so you had 2 million shares. Then the weighted average shares outstanding would be 1 million times 6/12 plus 2 million times 6/12, because half the year you had a million shares outstanding, and the other half you had 2 million shares outstanding. So in that case, it would be 1.5 million. You don't have to calculate it. That's just giving you an idea where the number comes from. All right. So if a company just has a million shares the whole year outstanding, its weighted average share will be a million. But weighted average shares there to try to adjust for stock issuances and buybacks during the year. So it's really kind of a piece of cake. You get net income. Let's say it's 4 million. In this example, this company had no preferred dividends, and they had 2 million weighted average shares outstanding. For each share, earn $2 per share. And we're always going to take our EPS just to the nearest penny right there. Okay? So even those $2 even, we're going to show that 0 because that's the penny spot. Now, what can you do with this information? There's what's called a price to earnings ratio. So of all the accounting numbers that are produced, earnings per share is the most watched number, most predicted number, most forecasted number. So if this stock was trading at $10 per share, the price to earnings ratio, price, $10 over 2, would equal 5. And we call this the PE ratio. And it's a very widely studied ratio. And what this is telling you is for each dollar of earnings, the market's willing to pay 5. So if you predicted next year's $3 per share, multiplied by 5, you would believe the stock's going to go up to $15. And I would say if you really were confident about that, then this stock would be a buy. Okay, we're going on to objective 12, or chapter 12, objective 12.1. We're going to look at the cash flow statement. Once again, we're not going to be creating the cash flow statement. This is from the perspective of analysis. So what are the purposes of the cash flow statement? To help investors predict future cash flows, to determine management sources and uses of cash, and help investors evaluate the ability to pay creditors and investors. So the ability to pay interest and dividends, and also to pay their bills. And also, we're not really going to touch on this one very much, but determine the relationship between cash flow and net income. So there are some investors who think cash is king, and others who also look at net income when assessing value. And there is a lot of highly technical analysis on the relationship between the two, but we're not going to spend a lot of time there. When you look at a cash flow statement, there are three sections. There's an operating section, an investing section, and a financing section. So this is current assets. Number one, operating section, operating activities generally relate to current assets and current liabilities. Investing is generally long-term assets, and financing is long-term debt or long-term liabilities, and stockholders' equity, SE. So operating section, basically after you have received all the cash you're going to receive from customers and paid all you had to pay to provide the good or service, how much is left over. So you want to see a positive operating cash. The investing section, well, companies invest in themselves so that they can make profits in the future. Generally, you're going to see negative investing cash. And in the financing section, you might see positive or negative, but most of the time it's positive cash. So the company's borrowing or issuing stock. Okay, so three sections. And from a perspective of analysis, the operating section, you want to see a large positive cash flow coming out of the operating section. So operating cash flow is a source of strength for the company. If a company has negative operating cash, there's really not a lot of things you could do to help it except find ways to make its operating cash flow positive. So investing is also important. You don't want to underinvest. If you underinvest, you may see your income and your cash flow start to dwindle in the future. So even though investing is going to be an outflow, it has to be balanced. You don't want to spend so little that it harms the future prospects for the company. So one measure that is looked at is called free cash flow. And all you do for this one, the simplest way to measure this, there are lots of different types of adjustments, but simplest way to look at this, usually take the cash flow from your operating activities, less the cash flow from your investing, and the difference is free cash flow. Okay? Positive free cash flow is good. What this says is the company can continue to reinvest in itself from its operating cash flow and still have cash left over for the investors. So free cash flow is good for investors. Financing, really, there's not a lot to pay attention to. Sometimes there are large transactions, sometimes there are very few transactions. And these transactions are easily visible on the balance sheet. If you have a debt issuance, you'll see the debt ratio change. If you have a stock buyback, you're going to see impacts on the leverage ratio. So even though this information is here, it's very transparent in other parts of the financial statement. It's the operating cash flow and investing cash flow that's more difficult to see without the cash flow statement. Okay, horizontal analysis, what is it? It's from left to right or right to left. So what happened between 2001 and 2002? Revenue went down 2%. What happened to cost of goods sold? It went up 3%. Went from 19,000 to 19,570. So we're going across the horizon. That's why it's horizontal analysis. And we have these, let's see what else happened. Sales, general administrative expense went up. Interest expense was unchanged. Income tax expense went up. Wow, even though our income before taxes went down. A lot going on here. Now, small changes in a big line like service revenue can trickle down to large changes in net income. So there's a third decline in net income resulting from a decrease in revenue, an increase in cost of goods sold, and an increase in selling general administrative expense. All right, so here we just have 2 years with horizontal analysis, you'd be looking quarter to quarter. You might have several years of data, but you get the idea. And on the balance sheet, we can also perform horizontal analysis. Um, it's less dramatic. Even the change here in accumulated depreciation, if it's a function of the useful life of the items, that the property, plant, and equipment. So that may not be too meaningful. All right, so here's my analysis, horizontal analysis of the balance sheet. Cash is up, good news, because the receivable and allowances are up too. So this would indicate that maybe management, this could indicate that they're trying to keep cash as a result of a bad credit situation. And if we reflect back on the income statement, the slower sales may reflect issues with credit quality. Maybe they lost a significant customer. A significant customer went bankrupt. Um, so they may need cash to get through a rough patch. Often that'll be a strategy of management, that they have something happen to one of their major customers. Not only is it going to affect your future sales, but it's also could result in a write-off for your receivables. Um, so we don't have all the facts here, but this analysis could point you the right way. So that's horizontal analysis. Next, we're going to look at vertical analysis.